It's a great pleasure to have with me James East, who is managing partner of the ACI Partnership Fund, a value oriented investment fund that has had very strong long term performance and has beaten the indices. I look forward to delving into the reasons behind this strong performance with James on this conversation. James, welcome.
Thank you, John. Glad to be here.
Well, James, I know you're a true value investor. Maybe we could just start a little bit with your background and how you got interested in value investing, and then how you started the ACI Partnership Fund.
Well, very briefly, I was fortunate enough as a young man, probably age 10 or 11, that was able to read Benjamin Franklin's autobiography. And though it doesn't specifically say in his biography, but he hinted at the eighth wonder of the world, which was compounded interest. And for whatever reason, that really stuck with me as a young man. Going forward, I was also able to be introduced to folks like Benjamin Graham and Warren Buffett, as many fellow value investors have done so also. And as Mr. Buffett says, either you get it in 5 minutes or you don't. And it appears that I got it in 5 minutes. So I basically read everything I could on Benjamin Graham and other value investor disciples, and kind of went from there.
Well, the quote by Benjamin Franklin is certainly interesting. Albert Einstein, I think, also remarked on compound interest, and we know that Charlie Munger is a huge fan of Ben Franklin, so you're in good company there. Maybe you could just tell us a little bit about some of the key principles behind your investment philosophy.
It's really, I guess it's what do you say, that you like to copy your heroes, and Charlie Munger is definitely a hero of mine, but more so, with Benjamin Graham's 1934 book, Security Analysis. Really, I've just been copying that, for the last 20 or so years. Even to this day, I'm quite amazed that folks don't follow the value investing process. So there's more than one way to skin the cat in the investment world. But the value investing of buying 50-cent dollars just speaks to me. And I'm primarily a balance sheet analyst, reading balance sheets and trying to identify some of those 50-cent dollars and purchasing them when I can, and selling them for $1 or more when Mr. Market is in a happy mood.
Well, I think you're being very humble there, because not all value investors have done as well as you have. And in fact, in 2008, the ACI partnership was up 10%. How did you accomplish that?
Primarily because of the value investing process wouldn't let me invest in anything. I couldn't find a whole lot of things to invest in back in really 2006 and 2007. So as we moved into 2008, I believe we were probably almost 40% in cash, just because we couldn't find the values or the 50-cent dollars. So we were primarily out of the market. We also held a fairly large investment in long-term bonds, because we were somewhat of the belief, and probably even so today, that at least we're in a non-inflationary environment, more so than a deflationary environment, but at least non-inflationary environment. So we like long-term bonds, and as the flight to safety, that helped us do quite well in 2008.
So that's an interesting view on long-term bonds, because a lot of investors that I've talked to, they do get concerned about inflation, and they think that long-term bonds are not a bargain at all. and certainly that may have been different in, let's say, 2007 or 2008. But what is your view on long-term bonds today, and do you still like them?
I would probably most likely be a buyer of long-term bonds today above, say, maybe 3.25. I think we're about 2.9% today. So I wouldn't be a buyer today. But on the other hand, I still think the long-term bonds potentially have some attributes that given where we are in the market, as we've had a nice run, there's still some cheap stuff out there, but depending on the amount of money that you're managing, that I still think that might be a good place to put some money. If we ever do get a scare in the market, you'll have a flight to safety again. I've been studying Japan for the last 8 or 9 years, and Japan is just a very, very interesting story, both as a country and as an economic model. So the amount of money that's been printed in Japan, I can't even get my head physically around how large the numbers are. But even though the numbers are that large, the bond rates have continued to go down for 40 years. So long term, meaning very long term, of at least in the U.S., 100 years or more, the average bond rate's only been about, we're talking long term bonds here, of about 4%, maybe a skosh above 4%, but we're not really that overinflated, or a bond bubble, if you will, compared to really long-term rates of 100 years or so.
And where does that leave your view on inflation? We're kind of talking a little bit about the macro here, even though I wanted to talk more value investing. But since we brought it up, maybe you could just tell us what you think of inflation. Has the Japanese experience influenced your view on what's likely to happen in the Western world?
Well, you're absolutely right. We're talking macro, and I look at macro as more so as a curiosity than anything. My day-to-day work is extremely micro with a very small m, because we run a concentrated portfolio of no more than 25 stocks and primarily around 12 to that 18 sweet spot number of holdings. But as far as the macro is concerned, I just cannot see where we're going to get any inflation. I mean, economically, most economists would believe that, or will say that most of the inflation comes from labor inflation. About 60 to 70% of the inflation you see will come from labor inflation, and there's no way that labor costs are going up for businesses. If anything, labor costs are actually going down for most businesses due to various reasons. So I just cannot see any inflationary pressures coming on, and you've seen maybe not a collapse, but at least a turning over, if you will, of the commodity complex, over the last couple of years. I mean, for example, we had probably one of the worst droughts in at least 50 years, maybe 100 years in the U.S. Agricultural prices spiked for a little while, but then they rolled over. And as we speak today, there's probably going to be the largest amount of acreage ever planted in the history of the United States this year, which I can't see as inflationary, going out 2 to 3 to 5 years.
Well, that's interesting. I think Prem Watsa would definitely agree with you. I want to leave the macro kind of there and switch a little bit to tried and true value investing principles and maybe how you look at investments. I was just reading in your quarterly letter that you had some springs uncoil, as you put it, in your portfolio. Maybe tell us about that as a concept. How do you look for stocks that you feel like are coiled springs, and what does it take to get some of those kinds of investments to actually perform?
Well, the starting place for us is always the balance sheet. We usually have varying degrees of what the market is like, maybe 50 to 100 on-deck candidates, as you will, in the batter's box, and just wait for them to hit our prices. But with respect to the coiled spring, I use various analogies, whether it's a coiled spring or 50-cent dollar, time arbitrage. All of those themes involve of very cheap stocks, and eventually, if they don't go bankrupt, which a balance sheet will tend to allude to, they will always eventually revert to the mean, which means they'll get back to fair value, which is at least $1, and hopefully more than $1 going forward. So that's where the coiled spring, time arbitrage, or 50-cent dollar comes from.
And what are some types of companies you tend to get most excited about? Are there specific industries or types of business models that you like to find?
Well, as I mentioned earlier with Charlie Munger, I spend most of my time on the negative process, meaning, I'm eliminating things than adding things, really putting more things into the too hard pile. I absolutely wouldn't even get near biotech. I have rarely ever gone into mining just because I don't understand mining. So it's more putting things into the too hard pile and just concentrating on some things that you can understand, and just continually reading 10Qs and 10Ks, and which a lot of people don't like because it's quite boring sometimes. But for me, I enjoy it because it's kind of like a treasure hunt. Every day you don't know what you're going to find in that 10Q or 10K, and hopefully it's a 50-cent dollar. But the primary goal of the value investing is, rule number one, don't lose money, and rule number two is always remember rule number one. So make sure that there's something there on the balance sheet or management paper trail that says that this company's not going to go bankrupt. They just hit a pothole. They've hit a speed bump for whatever reason, a bad management decision that they can get out of, just a product mistake that time will take care of. I like the equity side because no matter what's happened in the company, you have people working for the company. You have people showing up every day, at least trying to do the right thing and trying to make the business better, cheaper, faster. So as an equity investor, you always have somebody that's going to work, for you. Unlike maybe a bond or a commodity, indirectly you do for bonds, but I just like the equity side because I have that potential added competitive advantage. At least people are showing up to work to do the right thing. So that's what I look at is balance sheets and trying to understand that the company's not going to go out of business, and playing the reversion to the mean. And if you get lucky every now and then, you can get a company that made a mistake and the balance sheet's good. And it's a growing company. Sometimes the market, as I said earlier, Mr. Market, sometimes he's happy and sometimes he's depressed, and sometimes he just throws the baby out with the bathwater, and there's your opportunity.
Well, James, your fund actually has compounded at about 25% over the past 10 years, which is extremely impressive given what the market has done. And you've just talked about, stocks that sound like you're looking for the accident where you determine it's a temporary kind of thing, but I know you've also held some companies for a decade or longer and made a lot of money in those. So what would you say is your sweet spot in terms of ideas? Is it the long-term compounders, or is it the companies that get beaten up too much where you feel like they're not going bankrupt and there's a lot of money to be made just on the rebound that might happen?
I think the points that you made is probably a combination of all. We all react to the opportunities that we're presented with. I've been presented with, opportunities. You mentioned a gentleman named Prem Watsa. I just spoke with Prem Watsa a few weeks ago at the annual meeting, and about 10 years ago, I was in New York, and I met Prem Watson, and I thought he was an honest guy. I thought he was a straight shooter, and many folks in the investment community thought the exact opposite of this Canadian operator. The company got extremely punished in the market, some of it for good reasons, but majority of it for unfounded reasons. And so we made a fairly large position in that company, and it's done quite well for us. We've held that company for almost 12 years or so, going on our 13th year. So we're very comfortable with that situation. And depending on how the market is, we would add to it near the price that it is today.
Well, maybe we can talk a little bit about, how you go about finding these kinds of ideas. You just mentioned you met Prem Watsa some time ago. Is that how the investment came your way? Do you run screens? Do you talk to other investors? What is kind of your idea generation process?
I guess my primary idea generator is the 52-week low. Those things that are out of fashion at the time. Obviously, over the years, you build up fellow investors that have similar taste as you do, and you communicate quite often, if not daily, on idea generation. But screens help, but primarily just the 52-week low, just reading constantly, and keeping things on the deck. I believe Warren Buffett had mentioned that he had read 35 years worth of annuals of Anheuser-Busch before he finally ended up buying his first share of Anheuser-Busch. I've had similar stories where I've read annual reports of 10 or 15 years or so before I ever invested in a specific company, because eventually they hit a pothole. But I knew the track record, I knew the management, I knew the paper trail, and felt very comfortable moving money and capital into those positions based on the research I had accumulated over the years. So primarily every day, you come into the office and just sit down and start researching and seeing what your fellow colleagues and peers are doing, and build that database up and just wait for the fat pitch. That's happened, in 2008, 2009, and 2010. The markets have continued to climb the wall of worry, as the adage goes. There's not as many values out there today, but if you look hard enough, there's a turnover enough rocks. There's some things out there. Anyway, hopefully that answers your question.
Absolutely. And, you're based in Charlotte, North Carolina. I'd love to visit you there sometime, because it sounds like a great place from where to invest without kind of a lot of the influences that you might have in Manhattan. And you've been managing the fund since 1990. Maybe just tell us a little bit about how you've structured the fund, the relationship with your partners, because it sounds like you have the luxury of really thinking long term and being in cash a lot when you're not seeing ideas, and just essentially doing what you would do with your own money. So maybe just tell us a little bit about the business side of it, and how you have succeeded in setting up that kind of an arrangement.
Well, as part of full disclosure, the record that you see from 1990 is not all professional record, but moving forward, the our fund is essentially set up as a family office, and we essentially run it as a family office. Uh, Basically, I'm doing all the trading and the research. We have a board of advisors that overlook the advocacy for our limited partners. But primarily, I've turned a lot of money away. And as you said, we've had some fairly good returns. So you get calls from New York of wanting to give you money and whatnot. But one of the things that is very difficult is to turn money away because you don't know where the money's coming from. And it's usually hot money because they see good returns and they chase the returns. I would rather have folks that I know and understand the process that we have, which is long term. This is capital preservation, but also, we're looking at absolute returns. So we're looking for partners that understand that process and then really have long-term money. And when I say long-term, I mean 3 to 5 years. That we can go to 30 or 40% cash when we just don't see the value, or you get a big run in the market like we have now. We're still buying, but our cash is also building up as we speak. So there's still some opportunity out there, but not the plethora of opportunity, at least from the value sandbox that I play in, as it was, a few years ago.
And James, there's a section on your partner website about sell discipline, and I think a lot of value investors, don't get that quite right. They always feel like they're selling too early. How do you go about the sell decision, and do you feel like you've gotten that side of it right as well?
Well, let me back up just for a second. On the buy side, by far is much easier than it is on the sell side. You have fairly concrete, at least the process that we use, some very concrete ideas about what value is and metrics that help you in that buy decision. On the sell decision, as I'm sure you've heard quoted many times, it's more of an art, more so than an academic process. So once you've done it for a number of years, the art gets a little better. And as Peter Lynch used to say, he goes, I was a good investor for the first 10 years, but I was a much better investor, the second 10 years. And that's probably the same case for me. I've probably just refined my sell process a little better because value investors is true. We always buy too early and we always sell too early. So if anything, I guess on the sell side, I've become a little more relaxed in how I've sold some of our positions over the years and try to let them maybe run a little bit, because going back to the original comment about a coiled spring, I try to let that spring uncoil a little more than I maybe would have 10 years ago. So it's more of an art than it is science with respect to selling.
And James, given your experience, what would you say are some of the mistakes that value investors or investors in general tend to make in the market? What have you seen that you feel like keeps recurring, but folks could actually eliminate from their process?
Well, I think the biggest thing is being too heavily influenced by the screen, the metrics or the spreadsheet. I've been reading Buffett for nearly 20 years, and it's amazing that some of the things he says is just so true, but it takes a lot of time to sink in. For example, the spreadsheets, and I used to do spreadsheets and cash flows and all this other stuff in my earlier career of investing. But when he says, or Mr. Buffett says that, basically the only thing he uses is a calculator, when I first read that, I thought he was being a little facetious about it. But now I think he's absolutely true about it, and because I find myself really just using the plus and minus function on the calculator, and I don't get into all that other stuff. So from a value investor, some of the mistakes, I think it's paying too much attention to the screens and not getting into the more softer sciences, if you will, of understanding the paper trail, understanding the management, really understanding the balance sheet. So I say I'm a Ben Graham advocate, and he was much famous for his net nets, but I'm not interested in that at all. But I am interested in the deep value process, the 50-cent dollar, based on the balance sheet.
So, to what extent is management important to you? Do you evaluate management quite heavily, and do you need them to be owners in the business or to have demonstrated some sort of shareholder-friendly behavior, such as share repurchases, or are you fine with going with the business rather than the management?
I think as I go further and further down my investment career, the management just becomes more and more and more important. I'm reluctant to, even though it's a very, very cheap situation, I'm more reluctant to go into it if I don't know a little bit more about the management. I will buy a 50-cent or a 40-cent dollar just because of maybe the overhanging macro issue, whether it's in the shipping industry, etc. But I really, for the bigger positions that we take, you really need to know that management situation. The paper trail is just very, very important. What has this management said in the past? What have they done in the past? What are some of their returns or right moves? So management has just become more and more important for me anyway, as my investment career goes forward. But you can still, again, you can skin that investment cat many ways, but at least for the sandbox that I'm playing in, management's just become more important. They don't have to have a huge percentage because we're all people and we have different issues in our lives or family situations. So just because they don't own a big chunk of the stock doesn't always scare me. What I'm more important in is their conversation about what they're doing in the business. If they're performing correctly and walking the talk and doing what they say they're going to do, that's more important to me than some of these other metrics that other folks may be following.
You already mentioned Prem Watsa. Who are some of the other CEOs or managers that you respect?
Well, I would have to really just limit that to most likely the value folks. Whether it's Buffett, Munger, large portion of the management positions within Berkshire. Prem Watsa, which is the head of Fairfax Financial, but Prem gets a lot of attention, but he has some very, very astute managers that are within the investment decision makers within Fairfax. So, for me, those are definitely two of the top companies. I mentioned the Tisches, Lucadia, but those they have some new management transition going on. I don't know the new management team that's coming in as well, but folks that have presented the value process, and that speaks to me. So I'm kind of going on my bias, if you will, but those are a couple of names.
Well, James, as we wrap it up, could you mention a couple of one or two books that you found very helpful in your journey as a value investor that you would recommend to other investors?
Uh, well, I guess I'd have to at least mention one book by Marty Whitman and Schubeck as co-author. Our fund is named ACI, though it's not specifically spelled out. It's really a homage to Marty Whitman's 1979 book, Aggressive Conservative Investor, ACI. And that book spoke to me. It's not a book for everyone. It's actually in some cases a difficult book to read, but that's a book that really spoke to me. With the value investing, understanding balance sheets. That one becomes highly recommended. Aggressive Conservative Investor. But the other one's Intelligent Investor by Ben Graham, chapters 8 and chapters 20. Those are two books.
Well, on that note, James, I want to thank you so much for taking the time and for sharing your insights.